sit next to Saloni. We can cut down the last row. All right, okay. Guys, so let's start out with, I need to make a change. I put that in the video for the previous class as well. So the information, this is just contextual information. The information I gave you about the sugar contract, when I kept on saying it's actually listed on the NIBOD is a part of the CME group. Come in. Just wave people in, Vaishali. Just wave people in. No need to ask whether you want to come in or not. Okay. So the information I gave you was actually wrong, because it's not a part of the CME group. It's a part of the of ICE. Okay. There's this other exchange called ICE. I told you, Intercontinental Exchange, which is now just called ICE. Okay. They have a lot of contracts. This is where the sugar futures are. Okay. So it's just a matter. You have to be aware of all the major exchanges in the world. And so in this case, I was under the impression, so if it's not on the CME group, it's likely to be on the ICE, because ICE is the other major big exchange. And so the question here really was a very long answer to your question. Okay, I hope you didn't get confused by the answer. You got the answer that you wanted. Okay, I gave you a very long answer because I was trying to look at it from the point of view, how would you know? I added to her question. Her question was really, how would you know that it's a futures price? Okay, but I added to that question implicitly by saying that I've also added this other question: how would I know that SB is the ticker for sugar? Because I was trying to enter the sugar price. I wanted to see the sugar price feed, and I just entered SB because I know from having dealt with this contract before that I know that SB, the thing stuck in my mind, so I knew SB. But how would you know normally is that the process you would go through is you would know which exchange it's listed on. Okay, so eventually in this case I had the wrong impression, because the CME group, there was a time when they bought a lot of exchanges. So I had the feeling that they bought the NIBOD as well, but actually that was part of ICE. It's another major exchange. So you try with CME group. If it's not listed there, actually what we saw there is the cash settled contract, but the main sugar, this is called the world sugar contract. Okay, because as you can see here, the deliverables, again, look at the kind of in this sugar contract, when we do futures contracts, when we do, just wave people in, buddy, just wave people in so they don't have to ask whether they want to come in or not, whether they can come in or not. So you can see how many deliverable growths can be delivered against the sugar contract. When we look at futures contracts in detail, we will see that this is what happens in a lot of the futures contracts, that you can actually deliver against them. Okay, so if you trade in the sugar futures contract, if you're short, then you can actually fulfill your contractual obligation. Remember, short is a contract to sell, so you can fulfill, one of the ways you can fulfill your obligation is by delivering physical sugar, okay, against your short position. And these are the growths. You can, even India is listed here, you can see that. Okay, but it has to be delivered. They would have mentioned something about the Incoterms. At a port in the country. Okay, fine. So this, FOB. Have you heard this term before? FOB. You guys gotta learn this stuff. Okay, these are called Incoterms. I'm going to write this down in your session notes, so you have. Okay, so this stuff is called, so this is just some introductory. So the first thing is that the information about, this is 17.7, the information about this being, NIBOD being a part of the CME group was wrong. It's actually, NIBOD is a part of this, of the ICE, okay? The ICE is no longer a full form, okay? Okay, that's your... I'll set another alarm so that Garvit doesn't get restless. 11 a.m. No, it will. Okay, good. So what we are going to do now is I'll just complete this instruction. Okay, so these are Incoterms. You got to basically, this goes into the realm of things that you guys have to study on your own. Okay, Incoterms. These are called Incoterms. Essentially, is international commercial terms. Okay, so look up the ICC website. Okay, the ICC is the International Chamber of Commerce. It's not the International Cricket Conference or whatever. So it's the International Chamber of Commerce. Okay, so ICC. These are all the things that you guys have to look up. All these things are connected. The UNCISG, again, you can Google this stuff, okay? It's all there in your session outline, so this is in your folder. You don't need to note the keywords. Okay, I'm writing it down here. You need to note the instructions. This file is going to remain in your folder, okay? So this is stuff this goes into the domain of what you guys have to study on your own. Remember, you're in a professional program. We're not going to spoon feed you. I'm like your coach. Some stuff I'm going to work with you live on some of the stuff, and other stuff I'm just going to tell you, you got to do it on your own, okay? As if you really want to excel as a finance student, you have to take the ball and run with it on your own, because we don't have time in the curriculum to teach you all this stuff. I personally think this should be part of our curriculum. It's very important stuff. What is the UNCISG? The UNCISG is the United Nations Convention for the International Sale of Goods. You don't have to note it down because you can Google it and see it, okay? But ICC is the International Chamber of Commerce. So this is basically, whenever you have international sale of goods, this should be part of your, global business or whatever other kind of international business kind of curriculum, okay? Very important stuff. And then you have, so whenever there's an international sale of goods, you have, basically, most of the stuff is done on LCs. Have you heard of LCs? Letters of credit. Okay, so many of you might be going, for some of your seniors like Solanki and who else has gone into one of the girls has also gone into HDFC Working Capital Group. Essentially, they've gone into a classic relationship banking, wholesale banking role. Okay, where one of the things they're going to be doing is basically kind of going to customers and trying to sell HDFC Bank the classical commercial banking products like loans, guarantees, LCs. Okay, so one of the products they're going to sell is LCs, letters of credit. So you got to be very, it's a very technical subject. You got to be very familiar with this. It's your responsibility to learn. If you have any questions, you can come to me. But it's your responsibility to learn this, all this stuff. You must be a master of LCs. I remember they didn't teach us in Ahmedabad when I went to American Express Bank for my first job. We had rotations, and when I went to the trade finance department, they were telling me, "Hey, I'm Ahmedabad. You don't know what LCs are." Okay, so you should know what LCs are. Okay, by the time you go for your first job, you should know the whole product inside out. It's a very technical product. So let me just write it down. Letters of credit. Actually, the full name is. Okay, let me just write it here. UCP-600. This is also, you can. UCP stands for Uniform Customs and Procedures. Okay, so UCP-600 is the latest version of the document. So understand the connection. Okay, the United Nations Convention for the International Sale of Goods is the legal framework governing the sale of goods, international sale of goods. Most of the countries have signed up. Many countries globally have signed up for it. Okay, so I'm not sure about India, what we have done. Maybe we haven't signed up for it. I'm not sure. We have to check it. Okay, you can check it on this website who has signed up, but many countries have signed up. Okay, so once you have a sale, it's governed. That's a legal framework. There's a further legal framework covering letters of credit. Okay, so if I'm a Japanese exporter selling to an importer in Tanzania, I may not trust that importer's credit. Okay, I don't know if the guy's going to pay me, so he will say, I'm not going to pay you unless you open an LC in my favor. Okay, so you can read up all this stuff. So that's how the shipment gets done. That guy, the importer, has to open an LC in favor of the Japanese exporter. Okay, it goes through the whole channel of banks. So it's a very technical, complicated process, but you should master it on your own. If you have problems, you can come to me. So UCP-600 is just the name of the latest version. It's like Windows 10. It's like Windows 10. Okay, so 600 is like 10. Okay, so UCP-600 is just the latest version of the documentation that governs this entire intricate process of letters of credit. Somebody's going to open a letter of credit, some bank is going to confirm it, another beneficiary, okay, this, that, advising bank, confirming bank is a high technical jargon which you guys have to, we'll just ignore it. Okay, hopefully everyone can hear me. Who wants to come to, can we move Srishti to the front a little bit? Come and sit next to Tarun. Can you move in to your right, to your left? Let's move Srishti to the front. What about Burma? Can we move him somewhere? Maybe you guys can come here, all three of you. Bharat also, Bharat and Verma can come this side. Okay, so you're not so much at the back. Okay, all right guys, so we were talking about all this stuff that you have to, so this entire discussion starts from the sugar contract. All right, when you look at the contract specifications, so first is the error correction from the previous day. The NY bot is not a part of the CME group, it's a part of ICE. Okay, it's a different exchange. Okay, and this is a very important sugar contract. This is called the World Sugar Contract. There's also an American sugar contract. So this is, and you can see how many growths are deliverable, okay, against this kind of sugar, this sugar contract. You can take sugar from any of these countries, okay. And here I'm just taking off from this point. Where did we see the FOB mentioned? Here, settlement, physical delivery, FOB, receiver's vessel, okay. So that whoever is the buyer, you have to, FOB stands for free on board, okay. So which means you have to load it also. So the loading charges also you have to pay, okay. So 1 minute. All right, so we were talking about the stuff that you guys have to learn on your own, starting off, taking off from this point about the FOB, okay. So this kind of stuff, Incoterms, okay, which means essentially FOB, CIF. CIF stands for cost, insurance, and freight, okay, which means you are quoting this price. If you quote this price CIF, if I'm quoting a CIF price, which means this price includes cost, insurance, and freight. Which means if you're, let's say, a Japanese importer buying from, let's say, an Indian exporter, I'm quoting a CIF price. That means this price is good to take it all the way up to Tokyo Harbor, okay, because I'm paying for the cost of the product, plus the insurance on the product, plus the freight charges, okay. So it'll take you all the way to Port Tokyo Harbor, okay. So this kind of thing. So these things are known as Incoterms, okay. So this is the whole complex of knowledge that you should pick up. It's all connected. Sale of goods, international sale of goods, UNCISG framework covering that, okay. Then ICC, the important role of the International Chamber of Commerce, okay. So ICC has arbitration now. I think they have it in Hong Kong as well, but mainly it was in Paris. So if there's any dispute on international sale of goods, okay, it will be governed, it will be resolved through ICC arbitration, okay, which mainly happens in Paris, okay. So ICC will have arbitration, which is faster than litigation. Arbitration is supposed to be faster than litigation. So this whole framework is connected. Then the whole sale takes place under the letters of credit scheme, okay. These are called documentary credits, okay. The general term is documentary credits, okay. So this is all connected. Even if you are a finance manager in a corporation, you should understand, because most corporations will have some kind of international trade element. So this is also something that you have to understand if you're going to be a finance manager in a corporation, if you're working in the corporate finance department or the treasury department of any corporation, right? So this is also, so it's a very important body of knowledge, which I think actually should be officially inserted into our curriculum, because it's very technical as well. So UCP-600, as I said, is just the latest. 600 is the version number, okay. So UCP is Uniform Customs and Procedures, okay. So essentially UCP is, what you should read it at is UCPFDC, which means Uniform Customs and Procedures for Documentary Credits. So the full form of UCP is Uniform Customs and Procedures for Documentary Credits. So you have the UNCISG legal framework for international sale of goods, and the letters of credits system, documentary credit system, okay, uniform, standardized all over the world, makes a lot of difference, makes it very efficient, and they're all governed by UCP-600 right now, okay. Next time you have a different user, so generally it's the UCP that governs that. That's the UCP, Uniform Customs and Procedures for Documentary Credits, okay. So this is where you have the entire body of knowledge. You pick up all this knowledge, okay. So you should learn Incoterms, UCP, get some idea of the UNCISG. You don't have to go into the legal aspects of the sale of goods and all that, but at least you should know that this thing exists, okay. And maybe as a homework you can check whether India has ratified this treaty or not, okay. So essentially we have to ratify this treaty, the parliament has to ratify this treaty, okay. So whether we have signed up officially for this, all right, so you can check that, okay. So the first point, essentially, that how did I know the SB, so how did I know that SB was the ticker for sugar? Okay, I go around the exchanges. First I try on CME. I don't find the physically deliverable sugar that I'm looking for. Then I find the World Sugar Contract. It's on the ICE web page. So you will see product specifications. Sometimes these are called contract specifications. So here they write all the details about the contract, okay, the world benchmark, okay, and then this is the name of the product, and here's where you find that code SB. I remembered this because of my familiarity with the contract, and this tells you contract size. Once again, contract size reminds you of what concept that we have, which we have studied very recently? Lot size, correct? So contract size is lot size. Now you can't, if you're trading this SB contract on the ICE, okay, you cannot, and you'll notice that the CME group has a cash settled version of this contract, which you, against which you can't deliver, under which you can't deliver. But there also you'll notice that the contract size is the same, to improve liquidity in that contract, to make it, you know, comparable to the other contract. The contract size is the same. So 112,000 pounds of sugar. So every time you trade, so which means again this is your lot size. So you can't go to the ICE and say, I want to trade for 37,000 pounds of sugar. I want to buy 37,000 pounds of sugar. Okay, so you have to buy in, and the term that I should have used the other day, I kept on saying multiples of the market lot. Actually the word should be integer multiples, because technically 1.23 is also a multiple, but it's integer multiples of the contract size, okay, which is the market lot. So you have to always trade in integer multiples of the market lot. So this is the contract size in a futures contract specification page, is the equivalent of what we discussed earlier, the market lot. Okay, so the price quotation is basically dollars and cents per pound. Okay, so once again you can see here the difference. If you set up SB here, very small, okay, so if I set it up here, essentially you'll see that the price display that you saw on the previous day, as well, the price display will be dollars and cents per pound. Okay, in terms of price, so it's 2.7 or something like that. So the unit of base asset is 1 pound. Okay, the base asset is the world sugar of this benchmark. Okay, this grade of world is sugar, basically. You can just call it sugar. And the unit of base asset is 1 pound. Okay, and the market lot is 112,000 pounds. Is this clear? So we should actually add in this part where I'm talking about this part here. There is a part where I've said that the moment you encounter any market, when you're trying to understand what's happening in that market, or in terms of at least the context, the basic rules of that market, I've said at a point of time that for any market, yeah, okay. So here I have to actually add one more element. What is that missing element here? I've said base asset, terms asset, unit of base asset, instrument, whether it's an OTC market or an exchange traded market. What is the element that is missing here? Market lot. Very good. So you should also identify what is the market lot. So when you do that kind of investigation for the sugar contract listed on the ICE, okay, you find that the market lot is, what have they said here? 112,000 pounds. Okay, which means you have to always trade in integer multiples of the market lot. Is everyone clear so far? Any confusion? Anybody feeling lost in the way that we are progressing? In the initial module, we are trying to study markets, understand the basic operations of markets, how markets should be organized. Okay, so it's taking a little bit longer for us because we are approaching it from this point of view. Okay, we want to have a comprehensive view of global markets. So I want to give you a framework that gives you a comprehensive view of global markets, because most finance programs anywhere in the world will be taught from a from a security analysis point of view. Okay, so which means essentially what they do is they focus on these two asset classes, equities and debt. These are the only two markets these are the two types of assets which actually should be called securities, because these are actually these are securities against which companies borrow. Remember the what are the two elements of the liability side of a balance sheet? Yes? Debt and equity, right? Two forms of capital, debt and equity, okay? So when you look at capital markets also, you'll see it's split into equities and debt. We'll be looking at that classification. So you have to understand why our program, you have to understand how our program is structured, why it's structured in this way. Because I think that whenever you can get a more general framework, you should always use a more general framework. And there are large elements of commonality between markets in all asset classes. So there's no reason to study finance just from a debt and equities perspective, okay? So because in many ways debt equity markets are the same as currency markets and commodity markets. So you should understand the general principles of markets, okay? You'll see most of the time students come to me and say, I want to study stock markets. So I tell them that you should not study just stock markets, you should study markets in general. And then stock markets are a species of market, okay? One type of asset class. So you should always study it from as general a perspective as possible. That's why this is being taught in this way. So that's why at this stage we are just trying to understand the whole markets landscape. How should we classify the different markets into asset classes? How should we look at instruments? What are the types of instruments? And then how do markets actually operate? Okay, that's what we are going through right now. And in between we will have these kind of detours, like I went into this long detour about Incoterms and sale of goods and stuff, which is where you have to study on your own, the stuff you have to study on your own. Okay, so I hope nobody is feeling lost. At any time if you feel lost, you don't understand why we went from this topic A to topic B, what is the connection, please ask, okay? Instead of remaining confused, always ask questions. Is this clear to everyone? Okay, you see that in the last at the end of the last video I was praising Mittal actually for continually asking questions, although initially it seemed like I was saying that Mittal's question, when Mittal start asking questions, it's like a rapid fire round. As soon as you finish one question, the next question comes. So, but that's a good thing. That's not a bad thing. Please don't get discouraged. Okay, I just found it amusing that as your questions keep coming. So it's a good thing. So please don't get discouraged. Okay. All right. Okay. So in between you have this detour. Now we are going back to this. So here we should add market lot. So now we go back to the original what we were studying the other day. Okay. We started on players in financial markets. Okay, so we have these three high-level categories, and we have distinguished them with respect to what they do to their risk. Okay, so at this point we are not going to break up their total risk. We will later on, when we study risk management in detail, we will see that this total risk actually consists of the underlying position and the hedge position. We're not going to go into that now. At this point we will just understand hedgers as people who are looking to decrease risk. Okay, at this first level because right now I really want to get quickly to bids and offers, so you are ready to do your project. Okay, so hedgers, we just think of them as people who are trying to reduce risk. Okay, this is of course the qualifier is that this means that only if you're actually acting as a hedger. Sometimes people who should be hedgers don't act as hedgers. Like we have seen some reports in the press about even some of the Indian technology companies. These are publicly listed companies where they're not managing their foreign exchange exposures in a very systematic way. It's kind of haphazard. So sometimes if you don't have a proper risk management policy and you're not doing what you're supposed to be doing, okay, so in that case you may end up increasing your risk, but that does not mean that this definition is wrong. So if a hedger is actually doing what he's supposed to be doing, he should be reducing his risk. That's what this definition means. Okay, so sometimes you have cases like there was a company called Showa Shell, which is actually a subsidiary of a Japanese company and this Dutch company. So this guy went and entered into huge numbers of dollar yen foreign exchange contracts, which were far in excess of his actual exposure. And then he went and lost lots of billions of dollars for the company, and I think the company went bankrupt. So that's where he was actually increasing his risk, which he should not have been doing. Okay, but hedgers reducing risk means this is what you should be doing if you're actually doing what you're supposed to be doing. You should not be like breaking the rules and doing improper things. Okay, yes, Shreya, you have a question? Okay, all right, okay. So this is what it means. Okay, so at this point, understand hedgers as somebody who's looking to reduce risk, speculator is somebody who's trying to increase risk, okay, and arbitragers is somebody who's trying to lock in a profit without taking any risk. Okay, and the risk here that we are discussing in these definitions is only market risk. It does not refer to credit risk, which is the risk that I gave you the example that the furniture guy fulfills his contract, by delivering the furniture to my living room, setting it all up, and then I tell him, okay, bye, I'm not going to pay you. Okay, so I default on I don't fulfill my contractual obligation. So he has now basically seen a materialization of credit risk. Okay, so he has a problem now, he has to sue me, so it's a big mess, it'll take a long time. So now this is what we mean, so it's only market risk. Okay, so and then further we are dividing speculators into two parts. Okay, two categories: directional speculators and market makers. Okay, so why am I giving this kind of, let me first, so far is hedgers, so let me just give you some examples. Arbitrage, I don't want to go quickly too much into it. Okay, what should we write? Maybe we can write something here. We're not going to go because arbitrage is slightly technical. We have to, and this word is also very, it's very often used in the industry in the incorrect sense. Okay, when there is not, when we don't have, so we have to spend a lot more time on arbitrage. But the idea here is that simultaneously, the spelling is wrong. Simultaneously buy and sell identical asset. Okay, at different, I just want to fit it all into one line, so I'm writing in short form. Okay, so very shorthand definition of arbitrage, we are going to spend more time on it later on, but a very shorthand definition of arbitrage essentially is the simultaneous purchase and sale of the same asset. Okay, so if I find, let's say, somebody selling gold in Pitampura at say 1500 rupees, okay, and another person selling gold in maybe GK2 is selling at he's selling and the buying and selling price is the same. Okay, he's selling at 1200 rupees. So I buy from that fellow at GK2 at 1200 rupees and sell it to the guy in Pitampura. I have both of them on the phone together, and I just buy from him at 1200 and I sell to this guy at 1500. Okay, it's the same asset, it's gold. Okay, it's just that people don't have the right information, so they are quoting different prices, and I take advantage of that difference and I immediately lock in a profit. So I have no market risk left. If these guys all deliver on their contract, then the quantities are the same. Okay, so quantities are the same, and then if these guys both deliver on their contract, I will lock in a clean profit. Is everyone following so far? You get the basic idea? This is the main idea in arbitrage. Okay, so this we are going to call classical riskless arbitrage, where you simultaneously buy and sell the same asset. That's what we mean when we say that arbitragers are not looking to take any risk. They don't want to carry any risk. They want to instantaneously lock in a profit. Okay, hedgers, yeah. You use the mic.
So like NSE and BSE, if we see HDFC share, so there is a price difference in NSE and BSE. So will it be called arbitrage if I buy in NSE and sell it?
Yeah, if you can do it. If you can do it, it will be the same. It will also be an example of classical riskless arbitrage. Okay, so if you see here, now we have ITC here. Okay, 70-75 we have ITC here. Okay, now we haven't got to this topic of bids and offers yet, but essentially if I can buy, let's say this is the NSE price on this software for this feed, we only have NSE feed, we don't have BSE feed. Okay, so if I can buy BSE, if I can buy ITC on the BSE at anywhere less than, and I have to also factor in commissions. Okay, you have to factor in commissions also. So let's say there are no commissions for the sake of argument. Let's just assume there are no commissions. Okay, then if I can buy an ITC on the BSE for anything less than 271.70, and I can do it in huge volume. Typically arbitrage you want to do in massive volume, as high a volume as possible, because the profit is guaranteed. So why should I care? Okay, so if I can, I would like to buy millions of shares. So if I can buy, let's say 271.69. If I can buy like 10 million shares of ITC on the BSE, and if this price is good for 10 million shares also, okay, so if that, in that case, then I would buy at 271.69 on the BSE, and I would instantaneously sell at 271.70 on the NSE. Okay, So this bids and offer, we'll see when you want to sell, you'll have to sell on the bid, and when you want to buy, you'll have to buy at the offer. Okay, we'll get into that. That's actually our next topic. That's why I'm going through this, because market makers, these are the guys who are quoting these prices, so that we have to get to that point. But this is, you're right, this is exactly what it is. Okay, so you'll find that there are, so you will have certain desks set up in certain brokerage houses to do this kind of arbitrage. Okay, and so this again is, once again, is an example of how people are able to, so how arbitrage creeps prices in line. Okay, because as you start doing more and more of this, what will happen if you put if you buy, say, at 271.69, if you buy 10 million shares on the BSE for ITC, what will that do to the buy? This is an example of excess demand or excess supply. Excess demand. What does excess demand do to the price? Price will rise. Okay, so that price will start rising from 271.69, and here when you're selling 10 million shares at 271.70 on the NSE, this is excess demand or excess supply? Excess supply. And what does that do to the price? Pushes it down. Okay, so then the two prices will tend to converge. Okay, so that's what arbitrage does. Arbitrage, well, essentially arbitrage is sometimes also called the law of one price. That the same asset cannot have this two different prices. Okay, if it's an identical asset, and if you have to equalize the venue, of course, because sugar in New York, you can't buy sugar in New York, and against that you sell sugar in Madras port, because then you have to bring the sugar in New York to Madras port, or you have to take the Madras sugar to the New York port. Only then can you compare the prices. Okay, so you have to compare the freight also. So you have to remember it's in the same location. If you can bring it to this, you have to be able to bring it to the same location. Okay, and then you compare the prices for the same asset. Is this clear? So you get some idea of what arbitrage is, and that's why we say that arbitrageurs are looking to take no risk at all. They want to lock in a profit without any risk. Okay. Yeah. You give him the mic. Whenever you ask a question, I get a chance to drink some water. Yeah.
So does this practically happen?
Yeah. No, it's okay. So his question is, does this actually happen in practice? It does happen. So you will have certain desks which will be set up as arbitrage desks. I'm sure some of the Indian brokers would also have these kind of arbitrage desks, which are meant to take advantage of these kinds of momentary. But you, in general, in a market which is efficient and liquid, where there are many players, you would not expect these kinds of discrepancies to remain in place for very long. Okay, but short answer to your question is that it does happen. Okay, you do have deviations, and that's why you have arbitrage desks which are in place to capture these differences. Okay, but it's a very because sometimes you need high-tech infrastructure to do this as well. Okay, so it's a risky business to get into, especially in liquid and efficient markets, because you know that these opportunities will not exist for very long. So how much of a return are you going to get on your capital investment and all the infrastructure and stuff like that? But it's something that some desks, some brokers keep in place just to take advantage of these kinds of opportunities. But they can arise. In fact, in the international capital markets, we have seen some in the long-dated instruments, okay, like swap spreads and things like that, which you study later when you look at swaps. We have seen some prolonged cases of, persistent cases of prices being out of line with their arbitrage relationships, and they have remained that way because there are all kinds of regulatory constraints on banks and what kind of transactions they can do. So remember that prices, when they go out of line, okay, so if the ITC price on the BSE goes out of line with the NSE, unless somebody actually with that on the NSE, unless somebody actually comes and does the arbitrage, there is no force actually bringing the prices together, right? Are you following? Somebody has to actually come and do the arbitrage transaction to make those prices converge. So if you put restrictions, suppose SEBI comes and says that BSE NSE arbitrage is not allowed, some kind of rule like that, okay? So if you have any kind of regulatory constraint or a capital constraint or something, whatever it is, something that prevents you from doing the arbitrage, okay, then of course the prices, there's no pressure to bring the prices together. There's no force making the prices converge, and they can stay out of line, okay, which is what has happened in some of these cases like swap spreads, long dated swap spreads, okay, which we will discuss later. This is clear so far, everybody? Okay, yeah. Mike.
So can we actually sell
aren't the shares different? Like one is traded in NSE. Won't it be different in BSE? Like ITC, NSE is a different stock, I guess, and ITC, BSE is some different stock. So you can't cross trade, I guess.
No, I think that because you have this stuff does go on. So essentially, what you need, what he's getting at is the actual operations of the arbitrage. That you have to deliver the shares. So if you buy on the BSE, okay, and you have to you sell on the NSE, right? You buy on the BSE, so you have to take delivery when you fulfill the contract. You have to take delivery of the shares on the BSE, and you have to make delivery on the NSE because you have sold.
Shares,
yeah, physical. I mean, these are not physical shares anymore because remember these are now all book entry.
Yeah.
These are all now electronic book entry. That's what makes the arbitrage possible. But if there were no physical book entry, electronic book entry, you would have to physically, when you're fulfilling the contract on the settlement date, you would have to buy. You bought the shares on the BSE, you would have had to take delivery of the shares on the BSE, and you would have had to, because you sold on the NSE, you would have had to make delivery on the NSE. So you have to physically take the same, because remember, in a way, forgetting about the electronic book entry system that we have today, okay? Forgetting about that, going back to the old ways of the physical certificates, okay, helps you to understand the question. Very good question that he has asked. He's talking about the actual operations of the arbitrage. But look at the underlying asset. The underlying asset is the same. Common shares of ITC. In the old days, what you would have had is, you would have had share certificates of ITC. Now there are no two ITC companies. There's only one ITC company, and they have issued common shares. Okay, so what are you getting on the BSE when you settle a contract on the BSE? Okay, you have to just make sure that BSE and NSE are not in different cities. So in the old days, you would have had them in the same, if you have them in the same location, what you do is you physically take delivery of the ITC share certificates on the NSE, on the BSE, because you bought on the BSE. Those share certificates are fungible with whatever you're supposed to deliver on the NSE, because what are you delivering? You're delivering common share certificates of ITC. And ITC has only one variety of common shares, because preference shares are not common shares. You're taking common shares, and ITC, there's only one ITC. So actually the underlying asset is the same. Are you following? Okay, so if you forget about the modern system of the electronic book entry, but this will make it essentially easier, because when we have these clearing corporations, so there will be a connection between the two clearing houses, okay, where you can basically offset one against the other, and these brokers will have memberships of both clearing houses. They'll be clearing members of both the exchanges. But you can clearly see that if you go back to the olden days, you can clearly see how you can make it happen. You take the physical certificates, you run to the NSE, and you deliver it there, and it's the same asset, so there's no problem. Does that answer your question?
Yes, sir, but in ITC, like it's written also over there, ITC and NSE. So when you are trading like through TWS also, when you have only option of selling and buying. So how will you sell it into BSE? Like you get only option of selling. So you when you press sell, so it's sold in NSE.
No, but this particular software, because the feed that we have got is only the NSE feed. Okay, but for those who are doing the arbitrage, they would have feed from both the exchanges. They would have feed from both the exchanges, and the software would allow you to execute on, because remember here when you set up a stock, okay, when you set up a stock, let's say if we set up any stock, here you won't get smart routing. So let me try and set up some other stock, which is, let's say, Citigroup. Okay, so if I enter C, so if I want to set up Citigroup stock smart, now if you see the smart is actually talking about the routing part of it. Okay, so your question is now getting into the other question of the venues, which we discussed briefly in the answer to Mitchell's question at the end of the previous video, I think. That there's this concept of, you can have multiple venues, okay? So the BSE and SE are different venues. So you can actually set up, so what you would have in this particular software, because the permissions that we have only got NSE feed permission, okay? This broker's arrangement is only with the NSE. So their software, we can only see NSE feed. But in practice, you would have, for real trading software, live trading software, you would have the option here. Smart routing means, smart is actually a routing logic, Okay, so the smart routing means that IB will decide, interactive brokers will decide to which venue your order has to be sent for execution. So the prices that you see, but in fact when you go into the configuration page, you will see later on, we can do that once. You will see that in the US stock market you have multiple venues. You can decide to send it only to the island ECN or to a particular ECN or to BATS. You can decide to send your order to any exchange. Okay, so they give you the option. If you don't want to rack your brains with all that routing logic, you can just choose smart routing, which means IB will monitor the prices on different venues, and IB will use its own brains to decide where to send the order. Okay, because the order has to be sent to a particular venue for execution. That's why you have the BSE and NSE are different venues which are trading the same asset. Okay, so you can decide to route your order to the BSE and to the route NSE. So on a software where you have feed from both the locations, okay, you would set up one ticker for, as you can see here, this particular ticker says ITC NSE. If you read, I don't know if you can read it because it's very soft print, okay, but ITC, this says ITC NSE. This is to tell you that this price is for the venue that we call the NSE. So later on, if you had the option in a live trading software, okay, with a real money account, you would be able to set up BSE feed as well. So then you would actually do the buying on the BSE feed and the selling on the NSE against the prices. See, this is the feed. These bid and offer, this is part of our feed. We have the feed, that's why we can keep seeing these prices. Okay, like you saw in that particular video, the instructional video where I decided to buy TCS. You would have seen that day TCS was dropping quite fast, so the prices were changing very fast. So that's the feed that was coming in. Okay, and so here, so you would have a separate line like this, also showing ITC prices, but for the BSE feed. So you would hit the offer on the BSE feed, and you would hit the bid on the NSE feed, and that's how you do the transaction. And that and the settlement I already explained. If you go back to the old days and you imagine it, it's the same underlying asset, common shares of ITC. Is this clear? Okay, all right. Okay, so we go back. So we've done arbitrage. Okay, now hedgers. Let me give you an example of a hedger, and why do we say they want to keep on decreasing their total risk? Okay, so if you think about, say, Saudi Arabia, okay, so what is Saudi Arabia, you think, as far as their position with respect to the, since we are discussing oil, let's look at the oil price. We should actually be using Brent for Saudi Arabia. It's closer to their grade, but we can use West Texas just as a. So do you think Saudi Arabia wants the oil price to go up or to go down? Up, right? So they benefit. Everyone is convinced about. Saloni is not convinced. You want them to go. You think they want it to go up? Okay, all right. Everyone is convinced. SG1.
Yes, sir.
Okay. What is the problem if the oil price goes down? What is the? Why are they? Why wouldn't they like it?
Less profit margin.
Yeah, so less profit margin because they are producers. Indirectly, what you're getting at is that they are producers of oil. Okay, so they may cost. I think Saudi cost of oil is very low actually. I don't remember the figure, but it's a very low. They're one of the lowest cost producers of oil. Okay, so whatever be the selling price. So this is the international selling price. The global market sets the international selling price. So if the price goes down, their profit margin will reduce. Okay, so you can see later on we'll hopefully do a case study where a little caselet where you can see them talking about how the budget deficit in Saudi Arabia has. So the budget deficit in Saudi Arabia will go up or go down if oil prices fall.
Go up.
Budget deficit will go up. Okay, because the revenues are falling. Okay, all right. So here what we say, so Saudi Arabia is, and most of their oil has now been transferred to Saudi Aramco, which is the oil company. It's like their Indian Oil Corporation. Okay, equivalent of that, or ONGC. So Saudi Aramco is the company that basically has all the Saudi Arabian reserves of oil. Okay, so these guys now essentially what they are looking to do is, so they already have certain element of oil. Okay, we say that we can say that they are long oil. We'll discuss this in more detail when we do hedging and risk management. But essentially we say that Saudi Arabia is already long oil. Can you see that? You remember long and short?
Yes.
Okay, so Saudi Arabia is already long oil, although they haven't actually bought it from anywhere, but they have produced it. So it's like if you see me sitting at home with 10 phones, okay, you don't really know whether I produced those phones or I bought them from somewhere. You know that I have 10 phones. So whether I bought them or whether I produced them, it's the same result. I eventually I have these phones and I need to sell them, right? So it's like that. In that sense, we say that there's a better way to think about this, but we won't get into that right now. We'll leave it for our risk management module. But essentially, we can say that Saudi Arabia is long oil. Okay, so essentially what they are looking to do when Saudi Arabia is looking to act, we should be acting, if they're acting properly as a hedger, they should be looking, so obviously if they're long oil, now if the oil price starts dropping, going below like it used to be in this period, in the mid 80s, all the way up to 2001, 2003 or so, this time they were having a lot of problems, okay, so if it becomes like that, once again, if it falls below 30 and all that, 35 and all that, they're going to have a lot of problems, okay, so as a hedger, they are always going to try and reduce their risk, okay, so this is I'm just kind of giving you an example of what kind of profile a hedger has. So Saudi Aramco with respect to the oil market is a hedger because they already come to the table with a long position. It's not like you guys when you're starting out, you have a blank $1 million in your IBTWS and then Tarun decides to go and buy ITC. So he need not have bought anything, he could have just sat there for another few days, okay? He has no obligation, he decided to go on and take some risk. But these guys already, by virtue of being Saudi Arabia and having the oil and doing all their exploration and production activity, they are already now naturally long oil. Now they need to reduce their risk, they need to be selling oil. So essentially, so their first hedging activity will be to sell oil. Okay, so that's basically the idea here. That this is why we say that the hedger's first transaction should always reduce their risk. Okay, so let's say that they have, let's say $100 million barrels of oil in reserve. Okay, that's their inventory for the moment. Okay, so and they haven't sold this oil to anybody. They haven't entered into a contract. The moment they enter into a contract to sell 30 million barrels to India, then they don't have to worry about that 30 million barrels anymore. Okay, because the market risk is already closed. The contract transaction date has already happened. 30 million barrels has already been sold to India. So on that 30 million barrels, they sell it, let's say whatever, at $60. If they sold it at $60, that means now they know that for that 30 million, the actual delivery may happen 3 months later. That doesn't matter. Okay, because you assume here that India will not default on its contractual obligations. So delivery may happen 3 months later, but now the hedging team at Saudi Aramco no longer needs to worry about that $30 million because they've already sold it to India. Okay, so contract date is today, transaction date is today, settlement date will be 3 months later. But already the moment you do the transaction, your market risk for that $30 million is gone. Okay, you don't have to, now you only worry about the another $70 million. Okay, so this is what I mean by a hedger. When he's acting in the right way, the first transaction should reduce his risk. Okay, so the hedger basically when he engages in hedging, this is what hedging means. So typically when you go outside, when you go talk to people in the industry, you look on the web and all, you'll find all kinds of airy-fairy definitions of hedging. Okay, but you notice that this is a very objective definition. Can you see that? It's a highly objective. Is the person acting as a hedger? How will you find out whether the person is acting as a hedger? Assuming you have the information on his overall position. Okay. Now, if you know, instead of Saudi Arabia, we can look at Norway. What is Norway's position? Similar to Saudi or opposite? Not enough knowledge of the global economy. You should have this knowledge. Norway is the same as Saudi Arabia, another very big producer of oil. Okay, that's why Norway has one of the biggest sovereign wealth funds in the world. It's all that oil surplus which has gone into their sovereign wealth fund. So Norway is the same position as Saudi Arabia. Okay, they have oil. Okay, and they have to sell it. So essentially, when you're looking at a hedger, the first transaction will always reduce their total. Remember, see, they take this example. Saudi Aramco, let's say we go back to Saudi Aramco. Saudi Aramco had, the original position was 100 million barrels. They were long 100 million barrels. Anybody has difficulty with this concept that Saudi Aramco is long 100 million barrels? Okay, at this point we will just use this logic that whether they actually dug that oil from the ground and got 100 million barrels or whether they bought it from Trafigura or some other trader, the bottom line is now they have 100 million barrels. Is this clear? So now they're in a position when the price goes up, they will make money. The price goes down, they'll lose money. Is that clear? So they are holding on to 100 million barrels, so they're long 100 million barrels. So you see how their first transaction, this is actually not a hedging transaction, the sale to India, because it's actually the normal trade transaction. A hedging transaction is normally to be thought of as a different way. So maybe instead of selling to India, let's take it as a classical hedging transaction, where they sell, instead of selling to India, they sell futures contracts. They sell $30 million worth of futures contracts, 30 million barrels. Okay, so each transaction is for the contract size, I think, is 1,000 barrels. Okay, so you will sell 30 million barrels worth of futures contracts. Okay. So this is how a typical hedging operation would work. Okay, the sale to India is not a good example in this context because that's normally a trade sale. That's not to be considered as hedging. But if you sell 30 million barrels worth of futures contracts, okay, now what you've got is a situation where you have reduced your risk because you had 100 million barrels. Okay, and we'll look at the operation of futures contracts later. But you had 100 million barrels. Okay, now out of that you hedged 30 million by selling 30 million barrels worth of futures contracts. Now you no longer have to worry. Now you only worry about the 70 million barrels left. So now you've reduced your risk. This is clear to everybody? This is what I mean by reducing of why hedgers reduce their risk. Okay, the first transaction will always reduce their risk. Okay, all right. So you'll see later on why I mean why I've said first transaction, because later on you can always buy back if you feel that oil prices are going to go higher. You can buy back some of those 30 million barrels that you sold. That's more complicated. We're not going to get into that. That's why I've said first transaction. We'll see the importance of the definition later on, but this is a good way to remember. Hedgers will always be reducing their risk. Okay, if we forget about the dynamic management of the hedge position, forget about that. But hedgers, at least the first transaction, should reduce their risk. Okay, this is now you notice that this definition is very technical and very objective. Nobody can have a different view on this. If you know about the background of Saudi Arabia and Aramco and background of Norway, if you know whether they are originally long or short, okay, and then you see what they do in the market, you can see that you can immediately say that they are behaving as a hedger. Is that clear to everyone? You see, it's very objective because your total position information should be known to you, and then you see what they do in the market, assuming that you know this. So it's theoretically possible to know this objectively. Are you seeing what I'm saying? Right? That if you have the information, you can have this information theoretically. That's, and then you can actually see that they have reduced their risk, so they're behaving as a hedger, and so therefore this is a hedge transaction. This 30 million barrels worth of futures contracts that they sell, okay, this qualifies as a hedge transaction because it results in the reduction of their total risk. Are you following? Everyone is clear? Okay, what logic I'm using. So this is how we are defining hedgers. Speculators, I already gave you an example. Tarun sits with $1 million in his account and suddenly decides, if you look at his account, okay, so he has slightly more than $1 million, okay, and immediately he decides, now what he decides, now there's no obligation for him to do anything. He can just sit here and enjoy the interest, okay. You can see that there must be a position somewhere, I think. We have a position somewhere. Okay. Anyway, so suddenly he decides that, okay, he is very bullish on ITC, and suddenly he decides to enter a market order and buy.
You said how much more? You said
Order partially filled.
Yeah.
Order filled.
Okay. So this one at least went through quickly. If you want to reduce this. Okay, so you can actually say, change this from the configuration. Okay, let me find out where it is. So now what has Tarun done now? See now what has happened to his total risk. His market risk has gone up. Earlier his balance sheet asset side was only cash, $1 million cash. Now his balance sheet is $1 million cash plus whatever that value of the not $1 million cash has been reduced. The cash position has been reduced by, remember before I hit transmit, I saw a prompt in the window which was showing on the left hand bottom left, it was showing the value of the position. Okay, if you do it once again, you'll see what I mean. Yeah, here you see order type market. It's another market order, right? So you can see this is the value of the position. So his cash balance converted into, if you convert this back into dollars, his cash balance will go down. In this case, I don't want to buy anymore. I'll just cancel this. So now, remember the example I gave you earlier, his now balance sheet has become some amount of cash, but some amount of shares of 100 shares of ITC. Okay, now 100 shares of ITC, the market price keeps changing. The market price of cash does not fluctuate. That's why we say all cash is no risk. Okay, but the market price of ITC shares, which is the other asset that he's got on his balance sheet, that keeps fluctuating. So the total asset value will keep fluctuating. Are you following? Now he has got risk. Now he's got a position. Everyone clear? Shreya, you're not convinced? What? Little bit. No, there's no little bit. Either you're 100% convinced or not convinced. Give her the mic. What is she? Let's find out what she's not convinced about. So first step, think about this. When Tarun was sitting on $1 million of cash, asset side is all $1 million cash. Does he have any risk? No risk. Okay. Now what he has done, he's bought 100 shares of ITC. So his cash balance has gone down by a bit, and now the rest of the balance sheet has the other asset on the balance sheet. We say that the asset mix has changed. Okay, the asset mix has changed. Now he's got another type of asset, which is 100 shares of ITC. Okay, now that has a market price which keeps fluctuating. Okay, so has his total risk gone up? This is clear. Everyone is convinced? Yes, you're convinced that his risk has gone up. So what was your question?
So basically, speculators, why do they want to increase the risk in order to get more profit in future? Like,
yes. So you've answered that. Otherwise, how will you make money? In order to make money, sometimes you can engage in arbitrage where you don't take any risk, any market risk. Technically, there's some operations risk. There is credit risk. Okay, there could be credit risk. So, but you don't want to take any market risk for arbitragers. But speculators, generally, the first run, they want to take risk because they want to engage, they want to make profits. Okay, that's normally how you make profits. Okay, is this clear? Okay, all right. So, so you can see how this is a classic example of a speculator. Okay, whose first transaction has increased the risk. Okay, so now we are talking about the two categories of speculator. We have defined speculator. There's a further distinction made between within the category of speculators, directional speculators and market makers. Why do I say this? Because there's a reason why. Because here you'll understand the difference between the two types of business. Okay, the market making business and the directional speculation business. So if you go back to that example of this, let's say when I bought TCS. So in this case, what I did really was, so I looked at this chart briefly. So I looked at this chart and looked like an uptrend to me. And so Aurora was asking this question of why did you decide to buy and not to sell? Now the answer to that question is a very complicated answer. You can either go through FA or fundamental analysis or technical analysis to do that, and we'll spend a lot of time. Most of your finance theory is actually focused on this question. Like this basic question he had in his mind was, okay, how do I know whether to buy or to sell? Okay, should I buy or should I sell? And he was wondering how I decided to buy. Okay, so the answer to that question, the proper answer is a very long answer. We'll have to spend several sessions on that. But very briefly, I'm looking at it from a purely technical perspective. And the reason I decided to buy was that it looked to me like an uptrend that is still going on. Okay, so it's just a decision that when I initially, if you remember that day, it was falling quite sharply. Okay, it was falling quite sharply, but then when I looked at it, so I thought we should sell it. But then when I looked at the bigger picture, it seemed to me that more like an uptrend. Okay, as you can see here, this high this high is higher than this high. Okay, it went higher, so it's actually been making higher highs. And you see this long uptrend here. Okay, it's a continuous and the other long-term weekly chart also you saw is going higher. So I thought that this will basically go higher. So therefore, that's why I decided to buy. Okay, that is just to give. I mean, the idea there was not to really give you a detailed perspective on how you make the buy-sell decision, but really rather to show you how to enter orders. In that video, I was just trying to show you how to enter orders and how to enter stop orders, okay? So what you should understand here, you can see once again, if you look at a daily chart from 2013 also, it's been going up. So I'm just betting that this uptrend will continue, okay? So you could have decided to go the other way also. There's no real way to say other than finally what happens whether you make money or lose money. Only then you know whether your decision was right, okay? So, but at least you should know that, so how did I come to TCS? What were we discussing? Okay, right. So now why are we deciding? So when, just like when Tarun is buying ITC today and I was buying TCS the other day, I was also acting like a speculator. Is that clear? Because my initial balance was all cash. And I decided to change the asset mix on the balance sheet by spending some of that cash to buy shares of TCS. So I changed my asset mix to some cash and then 1,000 shares of TCS. And as you have seen, the shares of TCS have been fluctuating. You can see how much they fluctuate even in this short time, even in this 5 minutes if you see. Yeah, so you can see how just in a few days how much it has fluctuated. Okay, all right. Okay, what is the problem? Why is there so much murmuring? There's a mic problem. So this is coming from my mic. Okay. So what should? Oh, this it's disturbing you guys. Okay, then let me use that hand mic. Actually, we should have told this guy. Was this problem not there when that guy came? I switched it off. No difference. Okay, but why is it so disturbing? Just put up with it. What is it? I don't find, I mean, I find it irritating as well. Just ignore it. It's not that complicated. I mean, you guys seem to be very soft. A lot of small problems you get easily distracted and okay, I don't know what's happening now. Okay guys, let's not talk so much. Let's be quiet. Just have some discipline, okay? Discipline is the most important thing in the world. If you don't have discipline, I would say you don't even exist. You're like an amoeba or something. You're not even a human being, okay? Discipline is the most important thing in the world. You should always, you know who Sri Aurobindo is? He founded that ashram in Pondicherry. Okay, so Sri Aurobindo has this very famous quotation. He says, all life is yoga. Okay, and the way I interpret it is yoga is basically discipline. So all through your life, you're actually throughout your day, you are continuously in moments where you really have to control your impulses. Of course, you can't do it all the time, but at least you should keep that in mind. That you have to basically, yoga is basically discipline. Controlling yourself to do what needs to be done rather than what you want to do. Okay, so you can't do it all the time, but at least you should have that discipline. And many of the situations I find, many of you guys are actually not, they're very soft. They're easily just lapsing. You don't have this concept of discipline. Discipline is everything in life. That's all you need in life. Discipline. Okay, what is happening? There's a lot of talking here. I have to now deduct marks for SG1. I have to write it down. SG1, and who is his partner? Ganotra. Okay, so I'm going to write it down. The first penalty is because otherwise what's happening is nobody is sort of engaging in the class. All right, okay guys, let's go back to our discussion very quickly. We need to finish this. Why is everyone clear so far about speculators? I mean, you understand arbitragers, you understand hedgers, okay, how hedgers reduce their risk. First transaction will reduce their risk. Now let's come to speculators, and why am I distinguishing between two types of speculators? You are clear, you can see easily that in both examples of, the example I gave for Tarun and for myself, when we bought ITC and TCS, we have increased our risk The first transactions have increased our risk. Okay, so we are speculators. Now, why I would actually say that in both these cases we are directional speculators. Okay, why are we saying this? Directional speculators. Here, listen to look at this now. Here, now I bought TCS here. Let's go to a slightly longer view. You can see the stuff is moving around. Okay, so when I buy TCS here, what is my view? Obviously, my view, I take a slightly longer term view. But the point is that this basically just to move. Okay, let's make it a little bit short. Okay, so my view that it's actually going above 2,300, much higher than this. Okay, it's going to keep on making new highs. Remember, the moment you see me buying, see, there are only two types of trends, uptrend and downtrend. If we ignore the consolidations, usually if you go zoom out and see the long term, there'll always be either an uptrend or downtrend. Okay, so here there's clearly an uptrend, and if I bought, what does it mean? Do I think the uptrend is over, or do I think it's not over?
It's not
Not over. That's why I'm buying, because I'm a rational person. I want to make money. So you can assume that I'm a rational person. That's a safe assumption. Okay, and you see my actions, you observe that I'm buying. Okay, and you assume that I'm a rational person. Therefore, you assume straight away that this guy's view must be bullish. He must be of the opinion that this uptrend has not ended. Okay, so if the uptrend has not ended, what is the characteristic? What is the definition of an uptrend? Higher highs and higher lows. Okay, so if we take a broad view of the highs, if we don't want to look into this small up down movement here, if we just take this high and this low, okay, and we see that this low, we take this low, this high, this low, again this has gone for a new high. Okay, so we just take this one here, here and here. But if I believe that the uptrend is still not over, it is going to continue higher. Okay, it's going to remain, it's going to keep on progressing. Okay, it will keep on making higher highs and higher lows. Okay, so essentially that means it must eventually go higher than this, because this is the highest high so far. It will have to go higher than this. Okay, so that's where you basically, so this is where you can immediately figure out the person's view, if you know what degree of trend he is watching. Okay, you know that in this case I've said that I'm only watching this degree of trend. I'm not watching these kind of small views. Okay, this is clear. So now you understand. Now we'll come to the setting of the stop loss later. That's a different question. Why did I set my stop over here? That should also be fairly apparent, but we won't come to that. Right now I'm trying to show you why I'm a directional speculator. Now what needs to happen for me to make money on this position, because I bought it pretty much around here? The stock needs to go up a lot. Okay, so there needs to be upward movement. So even if I make it small, okay, even if I make it 15 minutes, look at a small, even if I'm looking not for movement above this, but maybe just movement up to 2200. So essentially I bought it around here. For me to make money, the stuff has to go up, right? Is this clear? Everyone's convinced? Common sense. It has to go up. If it has to go up, means it has to make a directional movement. That is a clear directional movement. It can't just hang around like this here, then I'm not going to make money. So when we say, though maybe you are a little confused by the word directional, it's a new word, but there has to be a directional movement, in the sense there has to be a clear upward or clear downward movement. Both are directional movements. Okay, here there is a clear direction, here it's not really moving anywhere, so there's a directional movement. This is clear. In order for me to make money, there has to be a directional movement. Okay, so that's why we are saying that this category of trader is this category of speculator, the subcategory of speculator is called a directional speculator, because he is speculating that there will be a big directional move in the price. Okay, you can argue what big or small. Maybe I take massive positions and I play for only small moves. Okay, but let's take a more normal case where you really would like to have big moves to make more profits. Okay, so you want to have a big directional move. So in order for directional speculators to make money, there must be a big directional move in the price. Okay, I've given both examples of Tarun and me. I've given examples of us buying, but you can apply it the same way for selling also. Even if I sell, I'm still looking for a downward move. Okay, so if I take a stock like, say, something like Tesla, okay, which is hopefully still in a downward spiral. Okay, so it's going up a little bit here, but if I look at, right, So if I look at Tesla and I feel that, okay, this rally will last, maybe it'll last a little bit more, maybe it'll go up to 300 or so. I'll wait for this. I'll sell it with a limit order, but I'll sell it at 300, okay, which my view is. Let's assume that I just sell it right away here. So I'm selling it here, okay, and I'm going to put a stop over here, okay. But obviously, if I'm going short Tesla, that means I need to have a big directional downward move to make money. If I'm selling means I feel this is bearish, it will go down eventually. That means my mental projection is, if I'm selling it immediately, my mental projection is that it's going straight down now, below all this 150 and all that, right? So therefore, to make money, I need a big directional move. So the reason I gave you this selling example is because I want to make it clear that this directional speculation is not tilted only to the long side. It can be either way. The point is, those who are making these kind of trades, they need a big directional move in the price in order to make money. Is everyone clear? The language may be a little bit odd, the directional speculator, but it's clear what I mean by directional move, big directional move, okay? All right. Okay, so that's why we call them directional speculators, okay? And we distinguish them, obviously. Remember, one of the rules of taxonomy is, where are we? Yeah. So see here, this again, I've got a sub-classification. One of the golden rules of taxonomy is that your taxa at any level, they have to be mutually exclusive. Okay, so you can't have categories where person can fit into either this or that. Okay, so essentially that means if I put the subcategories of speculators are directional speculators are market makers, and market makers, that means the market makers are not directional speculators and directional speculators are not market makers, right? So if I classify everybody into boys and girls, that means the boys are not girls and the girls are not boys. Okay, this is clear. This is one of the basic rules of taxonomy. So if you see anybody doing a classification where there is any confusion about this mutually exclusive category, remember mutually exclusive from set theory and all that, mutually exclusive, right? So that means boys cannot be girls, girls cannot be boys. That's why we have boys and girls categories. Okay, so so this is one of the basic rules of taxonomy, but unfortunately you see many cases even in textbooks where the taxonomy is not so clear. Okay, so and then it also has to be stuff on the same level. We're not going to get into rules of taxonomy. They also have to be same categories. Okay, like you can't have, since I'll just briefly tell you another important rule, which is you should not have a categorization which says like Japanese, Germans, Koreans, and then the other categories are Bengalis, Tamilians. Okay, because now you're mixing nationalities with like linguistic groups. Okay, so you should not have this on the same level. So you can have Japanese, Germans, Koreans and Indians on the same level, right? And then under Indians you can have Bengalis, Tamilians, Marathis. Okay, are you following? So it goes on a different level. So sometimes you'll see bad taxonomy even in books and all that, where they put like different classes on the same level, which you should not do. Okay, so these are the two important rules, that you should have only one type of item on one level, and then you should not mix the categories. Okay, they are not okay, we still have time, we're going to cover. So is everyone clear? I'm calling these directional speculators the guys who buy and sell typical asset manager, your HDFC mutual fund, buying shares, making a bet on shares. It's all directional speculation, because in order for them to make money, there needs to be a big directional move. Okay, either way, along selling or either going up or down. Okay, now what are market makers? Okay, why are market makers classified? So here, market makers are not like directional speculators, once again, because they don't require a big directional move in the price in order for them to make money. Let's understand what market makers do. Okay, so in fact, I can go a little bit further down, okay, and look at this. Okay, see here. Now we are looking at a market maker's price in ITC, okay, which is 271.15 to 271.20. Okay, so here the market maker, you can imagine this as a market maker quoting the price. Okay, even better is if you look at, first the NYSE has dedicated market makers, but we'll imagine here that there's a market maker making these prices. Okay, so remember, so if I want to sell ITC, which price do I sell at? 15 or 20? I would like to sell at 20, but do you think I'm allowed to sell at 20? If I am dealing with the market maker, let's say Shivam is the market maker, is quoting these prices, and I want to deal on these prices, and I want to sell ITC. on Shivam's prices. So do I have to sell at 15 or 20? So there doesn't seem to be very clear. I mean, there is an agreement in the class on what has to be the thing, what has to be the price. But this is one thing you have to understand: the market maker quotes these two prices, at one price at which he will buy, and one price at which he will sell. Now put yourself in Shivam's shoes as the market maker. If you are quoting prices to the outside world, okay, let's here is me, it could be also Shuchi coming and trading with him, okay, anybody can trade. He's putting out prices for the whole world, okay. Now look at it from his point of view. He has to quote two prices, one at which he will buy ITC and one at which he will sell ITC. So for him, he should offer to buy at he should he should want to buy at 15, or he should want to buy at 20. Shivam should want to buy at 15 and he should want to sell at 20. Okay, so what we say here is that this you see in your notes, okay, which is essentially bids and offers. Okay, the price at which the market maker buys the base asset is the bid. Essentially the market price at which the market maker buys, because the prices are for the base asset. The price at which the market maker buys the base asset, okay, so market maker, these are called two-way prices, one at which they buy, one at which they sell. Okay, so the price at which the market maker buys is the bid, and the price at which the market maker sells is the offer. Okay, the prices are always, you will know who is quoting the price. You are not quoting the price, somebody else is quoting the price. This is clear? He's the market maker, he's quoting the two-way price. So the concept here to learn is quotation of prices, quotation of two-way prices. Why two-way? One for buying, one for selling. Okay, and what is bid, what is offer? Okay, the price at which he buys, the market maker buys, is bid. The price at which the market maker sells is the offer. Okay, so now obviously, now we call market makers, now the name for them is price makers. Okay, we can also call them price makers. We can call them here price makers. I think I have it somewhere else, but we'll call them price makers. Okay, market makers, price makers, because we are going to distinguish them from price takers. Okay, so customer here, when I'm going and dealing on Shivam's prices, I am the price taker. I'm the price taker, I'm the customer. This is clear so far? Market maker quoting prices, quoting two-way prices, bids and offers. He buys on the bid and he sells on his offer. Okay, this is clear? So when I go and trade on Shivam's prices, if I want to sell, I have to sell at 15. And if I want to buy, I have to buy at 20. This is clear? Everyone is clear now? Go back and look at money changer prices. If you want to go abroad, when you guys went to Munich, okay, you had to all buy foreign exchange. So if you bought some cash, euros, okay, it makes it much clearer. All prices are shown as two-way prices, but you will see when you go to a money changer, look at the Thomas Cook page or somewhere, okay, you will see they have two prices, and obviously when you want to buy, you pay the higher price. When you want to sell, you get the lower price. Okay, and that's how these guys make money. Okay, so now you know how Shivam makes money. Okay, so he doesn't want actually, now why am I calling him a market maker, not a directional speculator? Because think about his business. What does he want ideally? Ideally, what does a market maker want? A market maker wants a situation like this. He doesn't want all this kind of dramatic movement. Okay, he wants, if you really want to sort of what a market maker wants is kind of like something like this, where if you assume that these prices are not very large swings, these are actually large swings. He wants the prices to remain reasonably confined, not much movement. Okay, the ideal thing for him is zero movement and massive volume of trade. So about 50% of the customers will be sellers, roughly, in the long run. Okay, we assume that about 50% will be sellers and about 50% will be buyers. Okay, so Shivam just sits there the whole day and he buys huge amounts at 271.20 and he sells huge amount at 271.25, and that's how they make money. So ideally, the reason I'm not calling them directional speculators, I'm giving a different category market, because the focus is very different. The business philosophy is very different. These guys don't want huge movement, because then it becomes very difficult for them to manage, because these guys also don't want to take a very strong view on the market. They just want to quote bid and offer prices, and they want to have massive volume of trade, about 50% on each side. Are you following? So that's why you see how the nature of this business is very different. Because when I buy TCS, I have to sit and wait for it to move up. Okay, these guys basically wrap up their business in one day. Typically, a market maker, most of the time, a classical market maker should be like a day trader. He should be going home with no position. Typically, if you're going home with a position, means you have a problem. You have some excess, because ideally it will not be 50-50 every day. Okay, so some days you'll have some imbalance. Maybe you have too many sellers. So you are. Okay, so you can actually, so we can stop here, okay, and so that you have a nice break. Okay, all right, okay, so we'll continue this way, but I think you understood now. Make sure you go and revise. By now, everybody should be clear why I'm classifying market makers as a separate category from directional speculators. And market makers said opting to buy on the bid. Okay, I don't want to say offering because this is the offer. This is the bid. This is the offer. When you go to trade, you always get the worst of the two prices. The worst of the two prices. Is this clear? You buy at the higher price. You sell at the lower price. So please revise these concepts. We'll move on to the next one next. Any technical questions, and I won't close the video. Any technical questions? Yeah. Technical question or non-technical? Non-technical. What is it? About the subject matter? Yeah. Then use the mic. Give her the mic. I can't hear because. Give her the mic.
I can speak like this.
Okay, give her the mic. Because there will be murmuring in the background. Yes, what is the question?
I wanted to ask that market makers are more like arbitrators because there are no risk. They are also, they don't
there is risk because, see, what you're asking is market makers are more like arbitrators. The answer is no. Because they do take risk. Because in real life, what will happen is when he's sitting there quoting prices, he's not going to get all the time instantaneously 50% of the volume on the bid side and 50% on the offer side, and then he's left with a nice profit and no position. No. In real life, what will happen is he will go through a phase where he'll get a bunch of sellers and he'll start accumulating, because if everybody goes and sells to Shiva, then his position in ITC keeps building up. So he has to look to move his price around a little bit, okay, or directly go and take a price from some other market maker and sell it. So his position keeps building up. So this is not a risk-free business. That's why they have been classified under speculators. If you look at it here, that's why market makers are classified as a subcategory of speculator, because they are taking risks. See, think about this. Say Shivam is sitting there early in the morning, no business done. Okay, so I come and sell 5,000 shares of ITC to him. Okay, at a price of 271.45. Now his first position is ITC. Now he's gone long ITC because I sold to him. Now what has happened to has his risk gone up or not? It's gone up because earlier he had no risk. Now I came and sold. So that's why he's a speculator. You see how these definitions are all highly technical, very objective, and they're always consistent.
So
you will never go wrong with the definition.
Risk, and in arbitrage there is no risk.
In arbitrage there's no risk.
In market makers there's some kind of risk.
Yeah, market makers. That's why they are a subcategory of speculator. And remember, if you are a subcategory, if I've defined all students as people who are carrying textbooks, that means whether you're a male student or a female student, you have to be carrying a textbook, and you will have some other characteristics which make you male or female. But if you are going to be a student, if you're going to be a male student or a female student, you must be carrying a textbook, because I have defined a student as somebody who is carrying a textbook. So therefore, if I am this market maker is a subcategory of speculator, so therefore he must have all the characteristics of a speculator, which means his first transaction must always increase his risk, which is what you'll see all the time. You start in the morning with a square position, then suddenly I come and sell 5,000 shares to him. Now he has got a position, his risk has gone up. So it's not risk-free. Arbitrager will instantaneously buy ITC on the BSE at 271.45 and sell it instantaneously on the NSE at 271.50, and he is left with no risk, no market risk. Is this clear? Okay. Yes. Next question. Technical or non-technical? Technical. Okay.
Yes. Like you were saying in arbitrage, you have to take on maximum volume.
Yes. No, I said in arbitrage, the statement I made was arbitrage because it's risk-free profit. You would always like to do it for as as high a volume as possible. If you are giving me free money, $5 per unit, I would want to do the deal for as many units as possible.
So sir, real life trading, always the volume you want is not, like huge volumes are not present in the market. I have seen that in virtual trading you can do it, but in real life,
In the difference between this, on this platform, what you see is what you get in real life. That's why on this platform, that's the superiority of this platform compared to some of the other software you're using. Here, all your prices are real prices. What you are selling today, 5,000 shares of ITC, whatever average price you get, at the same time, if a guy was doing a real transaction, he would have also got the same average price through this platform. So everything here is real except for the money. Okay, so this is a full it's a full simulation of, I don't like to use the word simulation because that has a different connotation. So yeah, but in real life you will get what you get, and that's all you can do it for.
like you can't order 10,000 shares of anything.
No, who said that? I mean, if it's there, it's there. Like the other day I was trying to sell some shares, I think, I don't know, ITC or something, and they said that not enough shares are available for shorting. So that's a situation at that point of time. So if the offer
does give this option, that,
so this software is a complete replication of the reality. That's why you see that when you did those trades, it took so long to get a trade done. Okay, here you have this one. You can see the decomposition here. This one is more. You have fewer trades, but some of those you saw were huge. Okay, so that's basically whatever it is. That's the reality. Right? Yes. Next.
Why there are price differences in BSE?
Mike. Yeah.
Why there are price differences in BSE and NSE stocks?
Why?
Why there are? You said now that there are price differences in BSE and NSE
No,
stocks.
I didn't say there are price differences. I said there could be.
Okay, it's not obvious. It's not every time.
It's not guaranteed to happen. In fact, most of the time you would not expect it to happen. If it's happening, even though it's momentary, maybe.
Okay, minute and
So in this case, maybe what might happen is this is 65.70. That might be like, well, here you don't have that kind of difference. It has to be 5 rupees. But it might be, if you don't have that constraint, it could be 66.71. But at 66.71, I can't buy at 71 and sell at 66 and make money. So the opportunity is not there. So in general, you don't expect big differences in a liquid market. And even if there are some differences, it may be momentary. There may not be an opportunity for arbitrage. See, if the price here is 70.75,
yes.
and the BSE price is 75.80, BSE is 76.81. Of course, here we have a 5 rupee difference rule, but let's assume that rule doesn't exist. So it's 70.75 NSE, 70.80 NSE, 71.81 BSE. I can't make money. I can't do arbitrage. If I have to buy at 81 and sell at 71, I'm not making money.
You are not making any profits. Yeah.
So, minute differences, momentary differences, not enough to make money. That's what you would normally expect in a liquid market. Now, if you have illiquid markets, that's a different story. But then illiquid markets, even for an arbitrager, that's risky.
So illiquid markets are?
All these faltu stocks that you get, all these Banana Republic stocks, small stocks, thinly traded stocks, which many of the brokers might want to push sometimes. That's why I told you that if you're trading, that's why I gave you guys a golden rule. If you're trading Indian stocks, do not go outside the Nifty 50. Period. No need.
Sir, I have a question.
Mike.
Sir, in stock market there are many buyers and sellers. Sir, if
Mike, use the mic properly.
Hello.
Yeah.
So in stock market there are many buyers and sellers. So if there are few prices being quoted, one is a bid and one is for us. So whose price is being quoted here? So obviously there are many bidders.
No, this is very good question. You're talking about the best bid and offer.
Yes.
So a platform like this is actually aggregating prices from different venues.
So how is this aggregation has been happening?
That's programming. You just write software for that. You aggregate prices from different venues. Okay. So let's say Kushbu is bidding 91. Okay. So you are bidding 93. Then Sakshi is bidding 95. They find that Sakshi's bid is the highest, so they'll show 95.
So it's mean they will show the highest bidding price and
This
lowest
is called the best bid and offer.
best bid offer. So the
Highest bid, lowest offer.
lowest offer.
I did
Best
not
bid.
get this.
So what he's saying, there are prices being quoted on different platforms. So how do they decide how to quote this, show these prices? So the logic is they aggregate, they poll everybody in the class. They put it this quote offering 11, okay, but maybe Tanya is offering 10. So they will not show Puneet's offer because his offer is higher.
Higher.
They will show the lowest offer and they will show the highest bid. So mechanically it's as if you go around the class and ask, hey, what's your bid, what's your bid, what's your offer, what's your offer?
But
And then you
show
take the highest bid and the lowest offer.
offer.
That's called the best bid and offer.
So can the software show five bidders or five?
Yeah, now you're getting into the concept of market depth. We'll have to see that. Now we'll do that another day because you have you're getting into the concept of market depth. You can try it on your platform. Why don't you experiment it? I think we have that.
I actually interacted with Cogency software. I didn't work on that, but someone was working on it. So there were actually five prices for US dollar.
No, that is Book Trader. Let's try Book Trader and see if we have that on ITC. But you try Book Trader on your own. I don't want to try see. Now you can see. Market depth, I was going to come to that. This is what ITC? Yeah. Now you are getting what you wanted.
Different prices you got into
Yeah.
different.
Now Mr. Mitchell is happy because he has got what he wanted. Now you're getting to see the market depth. Can you see that?
Yes, sir, yes, sir.
That's why they're showing you 279.95
Highest bidder is on
because
top and
there all you have people. Puneet is bidding 5,000 shares at 271.75, but he's not at the top of the book. So we'll do this next class, top of the book. Okay. So you can see it. You can practice on your own. Okay. Everybody's software isn't working. We forgot to ask that question. Is everyone's software working now? Yes, Tarun. Everyone's software is working now. All groups.
Yes, sir.
Please make sure that nobody has any problems. Please start practicing. Okay? Clear?
So one thing is like you are giving us 3 logins.
1 minute. Now let's close the.
Yeah.
No. We won't close it. Quickly. Tell me.
You have given us 3 logins, right?
Yeah.
So and one is for a project.
Yeah.
So we have only 2 logins for
You want more. You want more.
I want one.
Okay, anybody-
We are 6 people.
Please convey to the team. Anybody, I have some extra logins. Anybody who needs extra logins, please write to me.
For practice.
Yeah. But you already have 2 logins for practice.
So people are more in the room.
So like those.
You have more demand, excess demand. There's excess demand for logins.
excess demand.
So price of logins will go up. Okay.
Go up.
So I have some extra logins. Whoever needs logins, please write to me. And don't demand extra like people take extra food, no? Just because you're worried that somebody else will take it. So only ask for what you need.
Exactly.
Okay?
Yeah.
Please write to me and then I will send you the logins.
Fine.
Is that clear?
Yeah.
I'll try to write. I'll wait for. Please tell everybody quickly to write to me by today itself because I will distribute the logins today. Okay. All right.